This is Swing Trading with Heikin Ashi candles. Today we're going to discuss how they're different, how they spot trends, reversals, when to use, when not to use, and we have bonus material on how to be more effective. So stay till the end to learn all about it. Quick disclaimer, this is not personalized financial advice. So let's jump right into how Heikin Ashi candles are different from standard candles by switching back and forth between them. You'll notice a number of differences as we alternate back and forth. One of the things you'll notice is Heikin Ashi candles have no gaps, and this is fundamental to how they're calculated. You see, Heikin Ashi candles are actually mini averages of the current period versus the prior period. In this case, the periods are days, but they can be hourly charts, weekly charts, so on and so forth. Here's the equation for Heikin Ashi candles. I'll just leave it up for a moment, pause if you want to analyze it more, but you'll see that it does incorporate the prior day and the current day, or the prior period and the current period. In this chart of Amazon, I've highlighted important reversal candles, and as you can see with normal candles, it's a little less clear that these are reversal points, but when we turn on Heikin Ashi, you'll notice that each of these reversal periods starts with a doji candle. Doji candles have a long wick on the top and bottom and a small body. You'll notice that each of the doji candles in this chart highlight an important reversal period in the chart of Amazon. So now that we've covered bullish reversals with Heikin Ashi candles, now let's look how to spot a trend. Strongly trending Heikin Ashi candles tend to have longer wicks on their top, and more importantly, no wicks on their bottom, as you see here, 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 and here. You can tell that a trend is nearing its end when the candles become smaller and you start seeing red candles and wicks on the bottoms of the candles. Additionally, the doji candle highlighted here also indicates an end of a trend. You'll note that the exact opposite is true on the way down, with the wicks no longer on the tops of the red candles, and that indicates a strong downtrend. But when should we use Heikin Ashi candles, and are there certain time periods that work better than others? Well, the answer to that is yes. Since Heikin Ashi candles do incorporate prior periods, they tend to work better for longer time periods, such as daily or weekly charts. While Heikin Ashi candles can be used on the hourly chart, do remember that they do remove gaps between days, removing important market data from our visibility. That being said, Heikin Ashi candles are still good at finding the reversals and keeping us in trends longer, and I use them intraday on the hourly chart. Alright, so how can we improve on the Heikin Ashi candle trades? How can we be even more sure that we're doing the right thing? And the honest answer there is to compare multiple technical indicators at once, and you might not find that you're taking every single trade, and that's okay. But if you're taking the best trades, that gives you the best opportunity for the maximum profit. So one of the things we've been tracking on the S&P 500 over several months is this longer term downtrend. And you'll see that we are routinely hitting our head on this downtrend again and again and again. And then we also hit the 200-day moving average and bounced down off of that. So when I'm saying multiple indicators, I'm talking about watching for long-term trends like this. I'm talking about our 9-day, 21-day bearish crossover right here. And what does that coincide with? Yes, a doji candle, Heikin Ashi doji candle. And if we turn on our regular candles, aside from this 9-21-day cross, I can't say that this is actually as clear an indicator of a new trend as when we do turn on the Heikin Ashi candles. This Heikin Ashi candles definitely does help see the new trends and see the reversal indicators with these dojis, absolutely. But then with the Heikin Ashi on, we can see that we're falling down and we have no wicks on the top, meaning this is a strong trend. And if this was a trade that you were going to take on the short, and by the way, shorting is fine. I know so many people that are hesitant to short. If you're going to short on the S&P 500, QQQ, very large companies like Apple or Home Depot that are not going to get bought out overnight, that are not going to have such great news that they go up 50%. Those are, they're safe to short. If you don't, you can only make money when the market's going up. And as we've seen over the last several months, that's going to limit your opportunities considerably. So just keep that in mind. But back to this, if you did put in a short trade here, you had an opportunity, without taking this all the way to the extreme. You're not going to hit the other very bottom and get your 10% here, unless you're watching this all day, every day, and you're just an exceptional trader. But seeing this doji candle, three dojis in a row, you could have got a 7% return here easy. And we're in addition to these three dojis, right, we're also watching the Williams crash detector, and it turned green, right? It says we're crashing, we're crashing, we're crashing, we're crashing. But then we got this gray candle here, and then another gray candle here. When it starts alternating like this, it means the crash is basically over. Also, we'll notice that we have, the RSI, which was below 30, right? We got all the way down to 2024, which is actually pretty extreme for the S&P 500. That's an indication that this move is almost over. But then also we had these upper wicks. In addition to them being dojis, these upper wicks tell you that the move is over and the reversal is going to happen. Additionally, by the way, when the market was rising here, uh, in addition to some of these dojis and the trend markers, one of the things that told us this was going to roll over here was the RSI and the MACD divergence, right? The RSI was going down in a period when the market was going up. And so that means that the market really doesn't have faith in this move. And so those divergences are something always to pay attention to. It's somewhat rare for a divergence like this, where this is going up, this is going down. It's rare for a divergence like this to last very long without one of them snapping back to reality. Another thing, right? So we can see also this works the other way around. We have a low RSI, we have a MACD crossover. And what's happening at the same time of this MACD crossover? Well, we're starting to get these doji candles and a trending candle. And that's a good indication that we're heading back up. So if you were to grab something somewhere in this range and then start seeing these doji candles and the alternating wicks and the wicks on the bottom, right, you could have grabbed a pretty easy almost 5% gain there. And then again, right, on the way down, you're having these doji candles and this trending candle. But more importantly is you're crossing down below the 9-day moving average. And so this is an indication that, hey, you know what, this going up has stopped. We're starting to curl down. And again, if let's say you put in a short position right about here, you could have easily again got let's just be less aggressive, say a 9% gain. And 9% is really good. And then if you're playing options too, right, you could have a short put spread that you set up here, or I'm sorry, a short call spread that you set up here. And this could make 100% gain by having a spread that is going to expire worthless. And likewise for the reversal here, right? You could put up a short put spread here, knowing that the market's going to go up, and the short put spread would expire, with 100% gain. So there's multiple ways to play it. It's not just long and short a particular ticker. It can also be, using options, and definitely in at least the way I like to trade, I trade using the short spreads so that I'm selling premium to people. Because when you buy premium, right, if you're buying these puts or you're buying these calls, then you're fighting theta decay the whole way. And I'll post a link to the video where we talk about theta decay and why it's so difficult to win against theta decay. But yeah, so again, we have a 9-21 day cross. We did come down a little bit, but when we started trending with these trending candles back above the 21 and 9 day. This is indicating a really powerful rally. And if you used the Heikin Ashi indicators along with the fact that we did have a divergent trend here, right? MACD and RSI was increasing while the market was trading sideways. That's generally a good indicator. And let's say you got in on this trend, like you could have picked up a good 12% gain here. So my ultimate point is use multiple indicators. See that you're about to hit the 200 day and you could be bouncing off that. Be aware of what other traders are looking at. The ones on Wall Street, all your fellow retail, many of them are looking at these indicators too. It does move the market, and Heikin Ashi helps spot the trends and keep you in the trend when there's a bunch of noise. Because honestly, there's noise in here, right? But if you're paying attention to those Heikin Ashi candles, you're less likely to get out in a candle like that, because you know that you're still potentially in a longer trend move. That's Heikin Ashi candles. Next up, where will this market bottom? Watch this video to find out.